Hey guys, welcome back to my channel. Today I'm going to talk about why time in the market beats timing the market. Market volatility can be scary, and when markets crash and prices fall, people panic. And what happens when people panic? A lot of them sell their positions at a loss, wait on the sidelines, and wait for the perfect time to enter the market again. So this can appear like a logical thing to do, because when you analyze charts of past performances, it's easy to identify the tops and the bottoms of the cycles. However, in real time, this is extremely difficult to do, and very few people can get it right. So what most often ends up happening is that you sit on the sidelines and you miss out on the best gains. So in reality, if you want to be a long-term investor and not a short-term speculator, you actually have to stay invested in the market despite market crashes. And this is what I'm going to show you in this video. Over the long term, the market goes up. So the capitalist economy works in cycles. So you have cycles of expansion and cycles of contraction. So you have an expansion cycle which leads to a summit, then you have a crisis which leads to a contraction, which then leads to a bottom. Well, then you have a phase of expansion again, which leads to a new summit, which is higher than the previous one. But then there will be a new crisis which will lead to a new contraction, and then the base of that cycle will actually be higher than the base of the previous summit of the crash. So technically this is a cyclical phase. It works like this, but the long-term trend is generally goes up. So despite the numerous crashes that have actually affected the world economy over the past 40 years, the world GDP is still rising, and the USA GDP, so the USA, which is the #1 economy in the world, in 2019, before the coronavirus crashed, it reached a record level of more than $21 trillion. So despite everything, during every crash people think the world is going to end, the GDP keeps going up. So we can safely assume that with the coronavirus, it's going to be the same thing. We're now in a crisis which leads to a heavy contraction of GDP, but over the long term, economic activity will pick up and growth will return, which will lead to ever more creation of wealth. So the stock market, which is actually a reflection of the economy, works in the same way. You have what we call bull markets, which is when the markets go up. Then you also have bear markets, which is when the markets go down. The worst bear market was actually the financial crisis, or the Great Depression of 1929, which was very severe and lasted for a long time. But looking at this graph, we can notice that the bull markets are actually more numerous and last for a very long time, way longer than any bear market. So in fact, since 1946, the USA stock markets have known 50 years of bull markets, less than 8 years of bear markets, and approximately 15 years between the end of the bear market and the start of the bull market. So in fact, the conclusion of this graph is that bull markets last longer and actually generate way more gains than bear markets generate losses. So if you stay invested in the market on the long term, your gains will outweigh your losses. As we have just said, the stock market can be very volatile in the short term. But the fact is that over the long term, the gains you make will erase the losses you make. Furthermore, and even more importantly, waiting on the sidelines is actually very costly, because if you miss the best days of the market, your returns will be significantly less than somebody who stays invested and actually cashes in on these gains. So the following chart here shows you the differences in profitability of somebody who misses the best month of the year compared to somebody who stays invested the whole year. So sometimes the differences are quite slight, just 1 or 2 percentage points, but other years you have enormous differences when the market goes up in a very short amount of time, and then you have differences that can be up to 10 to 20 percentage points yearly. So over an investment lifetime, over 35, 40 years of investing, that will add up significantly, and you will lose significant money compared to somebody who stays invested for the whole year. So the lesson to learn here is that you have to stay invested long term, and if you take your money out waiting to re-enter at the right time, chances are you will enter at the wrong time and lose money. Because another thing that is important to keep in mind is that some of the best days of the market follow the worst days of the market. So after the market crashes heavily, generally they rally the next day, and then the markets go up significantly, but then by the time you inject your money, it's actually too late and most of the gains have already been made. So you will actually lose out on a substantial part of the rally. So this example can be seen, for example, during the 2008 financial crisis, which was also very severe. A lot of people took their money out of the markets, hoping to wait for the right time to re-enter. Well, there were studies that have been made, and for example here it shows the result of a $1,000 investment over the time period 2008 to 2018, or 2009, 2018, sorry. So if you didn't touch this investment, you would have an average annual growth of about 10.75%. But if you miss only the 30 best days of the period, your total return actually becomes negative 8%. So it goes to show that over a 10-year period, simply missing the 30 best days of the market gives you a negative return. So this, again, reinforces the idea that it's important to stay invested. And now the last study I want to show you will reinforce this idea even more. It's a famous study that I think for the first time appeared on Reddit, but it has since been published on numerous other financial websites to show just how important it is to stay consistent when you invest long term. So it's the story of three friends called Tiffany, Brittany, and Sarah, who each decide to invest $99,000 in an S&P 500 index fund from the period 1979 to 2020. But all three of them have different strategies which will produce very different outcomes. So let's start with Tiffany. Tiffany decides to save $200 every month into a savings account with 3% interest, waiting for the perfect time to enter the market. Unfortunately for her, she's going to have the worst market timing in the world because she invests her money the day before the worst crashes. So the crashes during this period are the Black Monday of 1987, the Kuwait War of 1990, the dot-com crash of the early 2000s, and then the 2007-2008 financial crisis. So every time she's going to inject her money right before the market crashes. But she will never sell her investment, and she will hold on to it for the next 41 years. So after 41 years, she checks her account, and her $99,000 investment became more than $770,000. So she multiplied her initial investment by a factor of 7.8, which is not bad at all. Now, Brittany decides to try to time the market, much like Tiffany. So she also saves $200 a month into a savings account, waiting for the perfect time to enter the market. But on the contrary to Tiffany, Brittany will have perfect market timing, which means she will buy at the absolute bottom of the market after the worst crises. So as soon as she buys, the next day the market goes up. So she injects money, again, after each of these worst crises. And then what happens after 41 years, she opens her account and she has $1.1 million on her account. So she managed to multiply her initial investment by a factor of 11, and she generated returns 45% superior to her friend Tiffany, who had the worst market timing. So she did pretty well for herself. Now you have Sarah. So Sarah has read about the stock market, and she came to the conclusion that it's very difficult to time the market. So she decided to try to not time the market at all and simply be what's called a passive investor. So when she opens her account in 1979, she programs fixed monthly contribution of $200 into this S&P 500 ETF, then she just completely forgets about it. 41 years later, when she checks her account, she discovers, to her surprise, that her initial investment of $99,000 becomes $1,620,000, so which is $500,000 more than her friend Brittany, who managed to perfectly time the market. The conclusion here is that it's important to stay invested no matter if the market goes up or down, because as we said earlier, the capitalist economy is a cyclical system which the long-term trend is inevitably upwards. So by investing, you know, even when there are down markets, that the market will eventually recover. So when you buy, when the market goes down, you're actually buying stocks at a discount. Okay, it's like if you go to a store and buy when products are discounted, you're getting a better deal than paying full price. Well, that's exactly what Sarah did. She was investing all the time, no matter whether the market was going up or down, and every month in between. And by doing that, she managed to generate greater returns than those who were actually trying to time the market. And this is actually also true of the investment world in general, because money is flowing into passive investments like ETFs and index funds simply because over the very long term, they have better performances and actively managed portfolios of even some of the best hedge fund managers out there. So some hedge funds, of course, outperform the market consistently, but those are actually very far and few in between. And if you look at this graph, it shows that money is going into passive investments because getting an average annual return of 7 to 10% beats any active management out there. And actually, if you go portfolio to portfolio and you compare the portfolio of somebody who invested in an index fund against somebody who's actively stock picking, chances are I don't want to put a percentage point on this, but the vast majority of the time, the person investing in a passive ETF, will have better returns than the person trying to actively manage their portfolio. So that is the moral of the story of this short video for today. I hope you enjoyed it. Please leave a like under this video to help me beat the YouTube algorithm. Subscribe to my channel to be notified of future videos, or leave a comment below if you wish to start a conversation and talk and develop more about this subject. So thank you, and see you next time.